My guess is that in 10 years, 5 of the 10 largest banks in the world will be digitally native companies. So it's still very early days, and I think there's a lot of opportunity. But the base layer winner in the work we do is Bitcoin is going to be arguably the most important blockchain because it's really good at storing value, and then Ethereum because it's really the compute layer. Becoming a boomer story is that the banks, who are the most powerful movers of money in the world, realize they can make a lot of money moving things on blockchains. So they are kind of descending into crypto. But at the same time, blockchain is enabling the creation of new financial institutions that will compete with banks.
Still watching your portfolio swing 20% and not knowing whether to buy, hold, or get out? You're not alone. Most people in crypto are just reacting. Very few are actually reading the market. This channel is for the ones who want to read it. Bitcoin, macro, on-chain data, institutional moves. We cover what actually drives price. Sharp analysis, no noise. If you're serious about this market, subscribe and turn on notifications. You don't want to miss what's coming. Tom Lee spent 7 years as JP Morgan's chief equity strategist. He's not a crypto native. He's not a Bitcoin maximalist. He's one of the most respected macro minds on Wall Street. And he just said something that should stop you cold. In 10 years, 5 of the 10 largest banks in the world will be digitally native companies. Bitcoin is the most important blockchain. Ethereum is the compute layer. And the fact that boomers are piling in right now is not a warning sign. It's confirmation. That's not coming from a podcast host or a Twitter influencer. That's coming from a guy who called S&P 7,300 before the market was anywhere near it. A guy whose research has been tracked by institutional money managers for over 2 decades. So when Tom Lee starts breaking down the crypto thesis in macro terms, you listen. Here's what most people in this space miss. The real story isn't retail. It's not even ETF flows, though those matter. The real story is what's happening at the infrastructure level. Who is making money? How much? And with how few people? Tom pulled 3 numbers in this conversation that genuinely floored me. JP Morgan. $60 billion a year. 300,000 employees. The most profitable bank in the world. Citadel. On pace for $40 billion this year. 3,000 employees. More profitable than Goldman, Morgan Stanley, and Bank of America. Tether. $15 billion this year. 300 employees. That ranks them as the 8th most profitable bank on the planet. Read that again. 300 people. 8th most profitable bank in the world. That's not a crypto talking point. That's a structural shift in how money moves. And Tom Lee is saying it out loud, on record, to a mainstream financial audience. What you're about to hear is the full breakdown. The tokenization thesis, the AI and blockchain convergence, why the boomer money is actually a bullish signal, and exactly where Tom thinks the base layer winners are.
Crypto has underperformed expectations. If someone was to look at why crypto matters today, I think there's 2 stories that are really central to what blockchain does really well. One is, of course, instant settlement and the ability to sort of confirm transactions quickly. And that's why Wall Street is tokenizing on the blockchain. And it's not even just a theory anymore. I was at Consensus, one of the big conferences last week in Miami. I actually spent the first part of that week at Milken. And actually both at Milken and at Consensus, the corporates, the financial institutions were all talking about how tokenization is a big unlock for their business. Because not only does it allow trading to happen 24/7, it starts to allow leverage or borrowing or monetizing non-traditional financial assets, whether it's like real estate or art, etc. So it's a real thing. And the second, of course, is AI is going to start to need a neutral way to both prove identity and to start to create transactions and to carry wallets. In fact, that's why Elon Musk kind of famously said multiple times in the last 12 months, the future of money is just mass and energy, meaning the nature of money is essentially compute and power. That basically it's all describing blockchains. And I think the reason it's becoming a boomer story is that the banks, who are the most powerful movers of money in the world, realize they can make a lot of money moving things on blockchains. So they are kind of descending into crypto. But at the same time, blockchain is enabling the creation of new financial institutions that will compete with banks. And I think we did a presentation at Consensus highlighting this very collision. JP Morgan makes $60 billion a year, the most profitable bank in the world, with 300,000 employees. Jane Street is a firm that is newer, just moves money around, trading with a lot of quant and compute. And this year is probably going to earn $40 billion. They just reported $10 billion in profit in the first quarter with 3,000 employees. So with 1/1000th the number of employees, they're almost as profitable as JP Morgan, and they're making more money than the second, third, fourth largest banks in the world. So they're more profitable than Goldman, Morgan Stanley, Bank of America. Tether, which is a crypto native, completely digital native bank selling a stablecoin called Tether, is going to make $15 billion this year, which would rank it as the 8th most profitable bank in the world with 300 employees. So I think that what's happening with blockchain is what happened with digital media, where there were the traditional studios and then there was Netflix, or with telecom, where there was long distance and local, and then there was cellular, and that the new entrants gained a lot of power relative to incumbency because of technological innovation. And I think that's what's happening in crypto today. So it makes sense that the boomers are descending on crypto. But my guess is that in 10 years, 5 of the 10 largest banks in the world will be digitally native companies. So it's still very early days, and I think there's a lot of opportunity. But the base layer winner in the work we do is Bitcoin is going to be arguably the most important blockchain because it's really good at storing value, and then Ethereum because it's really the compute layer. I'm actually going to go far back into the vault because many people might be more familiar with our more recent views and takes on markets. But I'd say that my favorite call that I ever made in my lifetime was in 2004, over 20 years ago. But it was in the middle of a wireless bear market. And all the wireless stocks, these were the carriers, had gone from, being $20 a share. I think my entire coverage universe was all under $10 a share. And so it was a very deep bear market driven by WorldCom and Enron and the loss of credit access. But the carriers I covered were actually pretty good businesses because they had this business called roaming. They had rural territories, and it was almost like a monopoly business. And one stock, Western Wireless, had fallen to $1.72. Okay. But I had called our bond trading desk, and those bonds had actually begun to rally. So that was the divergence, that the bonds were rallying, but the stock was still getting shredded. And there was all these rumors that the company was going to hit a wall. So I decided to upgrade that stock. And basically, I called the bottom to the day. And then within 18 months, it was bought by Altel for $40 a share. But that was the first of several upgrades I did, where I upgraded Alamosa Holdings at 27 cents. And then that was bought by Sprint for $22 within 18 months. And so the stock upside was great, but it was more because I knew these businesses and I learned something. Western Wireless had probably 1,000 employees. And what I learned was that when the stock was down, even though the company knew they were doing well, the fact that the stock was at $1.70 made everyone dejected. So I realized how important stock price was to how morale is. And similarly, when stocks do well, it really galvanizes the employee base. So that was a really important lesson for me. And of course, I was an equity analyst, so I really was covering companies all the time. The second story was probably my bear rating, my sell rating on a company called Nextel, because I had a bearish view on this company. It was a very popular stock with investors. And the fact that I was at JP Morgan and had a sell rating on a stock widely held by institutions and a big client of JP Morgan made me realize sell ratings are not fun things to do, because I felt enormous pressure. Like, I suddenly became someone that everyone hated because I had a negative view on something that they all like. So I realized the power of being contrarian, but also like how much heat there is. We still do that today because we can turn bullish when everyone's bearish, and it's the same thing. But being contrarian is not always fun.
So let's land this.
Tom Lee just told you that the largest financial institutions in the world are not debating whether to get into blockchain. They're already there. They're tokenizing assets, moving money 24/7, and building the infrastructure that will replace the systems they currently run. And while that's happening, a 300-person company called Tether is on pace to earn $15 billion this year. 8th most profitable bank in the world. This is not a speculative thesis. This is the current state of the industry, described by someone who spent years at the center of traditional finance. The reason this matters for you right now is position sizing and time horizon. If Tom Lee is right that 5 of the 10 largest banks in 10 years are digitally native, then the window to be early is closing faster than most people think. Bitcoin as the value storage layer, Ethereum as the compute layer. That's the architecture he's describing, and the ETF flows are telling you that the money is already starting to move. The boomer narrative is not bearish. It's the signal. When money that large, that slow, that institutional starts allocating, it does not reverse quickly. It compounds. If you found this breakdown useful, the subscribe button is right below this video. We cover macro, Bitcoin, and on-chain data every week, and we don't pad the runtime. If you want Tom Lee's full research, the link to a 30-day free trial of Fundstrat Direct is in the description. Watch this next. We broke down exactly what the ETF flows are showing right now and what the on-chain data says about where we are in this cycle. Link is on screen.
Let's go ahead and jump in here. So Bitcoin is trading just below $78,000, and I just sort of want to reiterate the psychology of a bear market and why it is so hard. There's a few points I'd like to make, right? And one of those is that bear markets always, and I mean always, make fools of both bulls and bears. So sometimes it actually is psychologically, emotionally easier being a bull in a bear market, because oftentimes in bear markets, the market will actually trend up. So if you're a bull in a bear market, you feel like you're the one that's right for a long time. And then there's just a few weeks where the market breaks down and it proves you wrong, but that doesn't mean that you weren't like cashing in on the credibility of being the bull for several weeks or several months before the market eventually proves that it was still in fact a bear market. So bear markets make fools of both bulls and bears. They make fools of the bulls because, well, the market keeps breaking down. Eventually, they make fools of the bears because the market trends up for months at a time. Now, I wanted to push back a little bit because there's some sort of sentiment going around that this is different, right? Like this time is different, and we've never trended up this long in a bear market in the past. And I would say that's just objectively not true, right? Like it's not true that we haven't seen these types of rallies in the past. In fact, in 2018, Bitcoin found a low in February, found a higher low in late March, early April, and did not even take out the February low until June. And it was late June, and when it took it out, it only barely took it out, right? Like, imagine if you flipped bullish on Bitcoin at, say, $6,000 in February 2018. You were right to be bullish during many of these rallies The problem is, while you felt like you were the one that was right, eventually the market broke down in Q4, and it led to sort of the market cycle bottom. Now, back in 2018, that was when I was in my last year of grad school, and I honestly, like, I didn't even look at the market from like, I think it was like from like March until September, because I had other things to worry about, frankly. And but I mean, I was working on my dissertation, right? But I mean, the bigger thing is, there was just nothing I could do about it. I didn't know exactly what the market was going to do, but I wasn't just going to waste my life watching the bear market play out. I had other things I wanted to accomplish. So some of the times it's okay to just kind of like take a step back for a while and just let the markets do a thing. I mean, the market's still gonna be there, hopefully. If you take a break. So just consider that. So I would say the psychology of a bear market is so difficult because you get so many of these rallies. And if you look at the amount of time it will take in a bear market to put in a new low, I want to show you how this time is not really that different. Look in 2022 when we put in the low in June. How long did it take to put in a new low? About 21 weeks. How long in 2018 after the February low did it take to put in a new low? About 19 weeks. If you look at 2022, it didn't take as long, but still took about 15 weeks from that, from that low. If you go from the June low in 2018 to then when we took that low out, it took about 21 weeks. So in 2014, from the low in April to take that out, it took about 25 weeks. So you can see that, we've had some of the longer ones, 19 weeks, 21, 21, and 25. Yes, there was also this one that was 15 as well, but it can often take 19, 21, 25 weeks to put in a new low. And when you look at how long it has been, it's only been 14 weeks, right? Like, it hasn't even been 19, it hasn't been 21, it hasn't been 25. If it takes 19 weeks, that would put the next low in June. And note that major lows have occurred in June before, right? June of 2018, June of 2022. There is a chance, and again, this is where the, sort of the snide comments come from. You're saying it could go up or down. But there is a chance, like in 2014, that a high was set in June and then you went down into October. June is often a turning point for the market in a lot of the bear market years, right? It'll often put in lower highs in June. Even in 2019, the high came in June. So I think you'll likely either see a high or a low in June. But regardless of what happens in June, I still think you'll go lower into October. Okay. And so if it took 19 weeks, it'd be about mid-June. If it took 21 weeks, you're looking at late June. And if it took 25 weeks, you're talking about late July. Now, here's the thing. In 2014, when June was a high right here, you still had a pretty big drop the following week, right? Like after that rally into very early June. By the way, the rally topped in early June. It's only like 2 weeks from now. Right after that, you had about a 23% drop, a counter trend move, and then from that top, then another 30% drop very soon thereafter. So look, right now, Bitcoin is still struggling with the 200-day moving average. And that is an area that it often struggles with in bear markets, is that 200-day moving average. You can see that it provided resistance in 2022, and it also provided resistance in 2018. Now, in 2019, you can see we got through the 200-day moving average. And in 2014, we got through the 200-day moving average very briefly, right? So like it can happen. I'm not here to say that it's impossible for it to happen. In fact, again, looking at the fib retracement stuff, you can see that oftentimes Bitcoin does rally back up to the 0.382 before then going down into the next sort of the leg of the bear market. In 2014, that high came in June. In 2018, after that initial drop into February, the rally to the 0.382 came in February and March. In 2022, the rally to the 0.382 occurred in April, right? In 2019, it went a little bit higher, right? It actually rallied all the way up to the 0.5 before it went down. The point is like, no matter how high it rallied in those bear markets, it then eventually rolled over. And so for me, like, I can't sit here and tell you with, a strong confidence that I know exactly where Bitcoin will find that resistance at. I mean, could it be the 200-day moving average like it was the last 2 cycles? Absolutely.
Still watching your portfolio swing 20% and not knowing whether to buy, hold, or get out? You're not alone. Most people in crypto are just reacting. Very few are actually reading the market. This channel is for the ones who want to read it. Bitcoin, macro, on-chain data, institutional moves. We cover what actually drives price. Sharp analysis, no noise. If you're serious about this market, subscribe and turn on notifications. You don't want to miss what's coming.